For decades, silver has quietly powered the modern world. It does not dominate headlines the way oil does, and it rarely inspires the same fascination as gold. Yet beneath nearly every major technological leap, silver has played a critical role. From electronics to medical devices, from solar panels to data centers, silver has been embedded deep inside the systems that keep modern life running. That is why what is happening now has caught many analysts off guard. A single technological shift, emerging from one of the world's most powerful electronics companies, could disrupt the silver market in a way that few people are prepared for. The implications stretch far beyond batteries, far beyond smartphones, and far beyond a single corporation. If this technology scales, it could alter global supply chains, reshape industrial demand, and force the silver market into a completely new phase. The mystery is not whether innovation will continue. The mystery is whether the silver market is prepared for the consequences of that innovation. To understand why this matters, it helps to understand how silver became so deeply intertwined with modern technology in the first place. Silver's industrial role did not emerge overnight. Long before it became a financial asset or hedge, silver earned its place through physics. It is the most electrically conductive metal known. That single property made it indispensable as electricity began to define economic growth. As communication systems expanded, as electronics became smaller and more complex, silver quietly replaced alternatives that could not match its efficiency. By the late 20th century, silver had become essential. It appeared in circuit boards, connectors, switches, and conductive pastes. The rise of renewable energy only accelerated this trend. Solar panels rely heavily on silver-based components to efficiently convert sunlight into electricity. Electric vehicles increased demand even further as batteries, charging systems, and power management circuits multiplied silver usage across every unit produced. This steady expansion created a delicate balance. Silver demand grew year after year, while supply struggled to keep pace. Mining production did not rise fast enough to absorb the growing industrial appetite. Recycling helped, but not enough to offset consumption. The market entered a quiet deficit, one that did not trigger panic but gradually tightened availability. For years, this imbalance was manageable. Silver prices moved, but not violently. Inventories absorbed shocks. Manufacturers optimized usage. Substitutes were explored, but rarely adopted at scale. Then battery technology entered a new phase. Energy storage has always been the limiting factor in technological progress. From smartphones to electric vehicles to grid-scale storage, batteries determine how fast innovation can move. Improvements in energy density, charging speed, and longevity reshape entire industries. Samsung, like many global technology leaders, has invested heavily in this space. Its research divisions have explored solid-state batteries, advanced lithium architectures, and new material combinations designed to overcome the weaknesses of traditional designs. What makes this new wave of battery development different is not just performance, it is material composition. Certain advanced battery architectures rely more heavily on silver-based components than previous generations. Silver is used in current collectors, specialized contacts, thermal management systems, and high-efficiency conductive layers. In some experimental designs, silver improves charge stability and reduces degradation under high-stress conditions. If these designs remain niche, the silver market absorbs the impact quietly. But if they scale, the math changes dramatically. Consider the scale Samsung operates at. The company is not a laboratory experiment. It is one of the world's largest producers of consumer electronics, energy systems, and semiconductor components. If a battery design becomes commercially viable and is adopted across smartphones, electric vehicles, energy storage systems, and industrial applications, demand does not rise gradually, it surges. This is where cause and effect becomes unavoidable. Silver supply is not flexible. New mines take years to develop. Existing mines are often byproducts of other metals, limiting how much silver output can be increased independently. Recycling has physical limits. You cannot recycle silver that has not yet reached end of life. When industrial demand rises faster than supply, pressure builds invisibly at first. Manufacturers compete for contracts. Premiums increase. Inventories thin. Eventually, pricing signals emerge. The silver market has experienced versions of this cycle before. In the past, photography once consumed vast amounts of silver. When digital technology replaced film, demand collapsed. Prices adjusted. The market stabilized. But today's environment is different. Digital transformation does not remove silver from systems. It embeds it deeper. Solar energy adoption continues to grow. Electric vehicles are expanding globally. Data centers multiply to support artificial intelligence and cloud computing. Each trend independently pressures silver supply. Combined, they form a structural demand wall. Samsung's battery developments do not exist in isolation. They arrive at a moment when silver inventories are already tight, when industrial demand already exceeds mining production, and when geopolitical supply chains are more fragile than they have been in decades. This convergence is where the breaking point begins to form. Markets rarely respond immediately to structural change. They respond when constraints become visible, when delivery times extend, when manufacturers quietly redesign products to reduce metal usage, when long-term supply contracts lock in volumes years in advance. Those signs are already appearing across multiple industries. Silver users are optimizing designs, not because silver is expensive, but because availability matters more than price stability. When access becomes uncertain, risk management replaces cost management. Some argue that innovation will simply eliminate silver dependency. History suggests otherwise. High conductivity materials are difficult to replace without performance trade-offs. Copper cannot match silver's efficiency at scale in high-density applications. Alternatives exist, but adoption is slow, costly, and rarely universal. This leads to the most misunderstood phase of the cycle: failed fixes. Technological optimism often assumes substitution will solve scarcity. But substitution requires time, capital, and regulatory approval. In energy systems, reliability matters more than novelty. Manufacturers do not switch materials lightly when safety, longevity, and performance are at stake. Another proposed fix is increased mining. Yet, silver mining faces geological limits. High-grade deposits are rarer than in previous decades. Environmental regulations slow expansion. Capital investment is cautious after years of price volatility. Recycling helps, but it follows consumption, not anticipation. It cannot respond instantly to surging demand. As these fixes fall short, pressure accumulates quietly. This is where modern parallels emerge. The semiconductor shortages of recent years followed a similar pattern. Demand rose steadily. Supply chains optimized for efficiency rather than resilience. A shock exposed fragility. Prices surged, production halted, entire industries paused. Silver is not a chip, but the dynamics rhyme. When a material becomes essential across multiple growth industries simultaneously, shortages do not announce themselves with headlines. They surface through delays, premiums, and quiet reallocations of supply. If Samsung's battery technology scales, silver demand does not spike temporarily. It shifts permanently to a higher baseline. This matters not only for markets, but for economic planning. Energy transitions depend on material availability. Industrial growth depends on predictable inputs. Financial systems price risk based on assumptions of continuity. When those assumptions fail, repricing follows. This does not mean collapse is inevitable. It means adjustment becomes unavoidable. Silver's dual identity complicates the response. It is both an industrial input and a financial asset. Industrial users want stability. Financial participants respond to scarcity signals. When both converge, volatility increases. History shows that markets underestimate slow-building pressure and overreact when limits are reached. The lesson here is not fear, it is awareness. Technological breakthroughs do not exist in isolation. They ripple through supply chains, markets, and economic structures. Battery innovation does not only change devices, it changes demand curves, investment flows, and material strategies. Samsung's research highlights how quickly these ripples can become waves. The silver market has operated under the assumption that demand growth would be gradual and manageable. That assumption is now being tested by overlapping forces that reinforce each other rather than cancel out. Understanding this shift matters because it reveals how fragile modern systems can be when efficiency replaces redundancy. The real story is not whether silver prices rise or fall in the short term. The real story is how industrial dependence reshapes market behavior over time. 3 lessons stand out clearly. First, technological progress often increases material dependence rather than eliminating it. Efficiency gains create new applications faster than they reduce old ones. Second, supply chains built for cost optimization struggle when demand accelerates unexpectedly. Resilience requires slack, and slack is expensive. Third, markets react late to structural change, but react strongly once constraints become visible. The open question is not whether silver will remain important. It is whether systems that rely on it are prepared for sustained pressure. If this explanation helped you see how a single technological shift can ripple through global markets, you can support this work by engaging with this video in whatever way feels natural to you. It helps bring these ideas to more people who may need the same clarity, because the most important shifts rarely arrive with noise. They arrive quietly, embedded inside progress itself.